Let me tell you guys two stories real quick, and then I'll answer some questions, and we'll get on into the finality here. I don't normally tell like war stories just to tell stories. There's always a purpose in general whenever I tell a story. So this first one is about Michigan sentiment, and this I like to share this story because it gives you an idea still of what a disadvantage you're at compared to other players, and it helps you understand why certain things happen. And I just think it's stuff you need to know, even if you're not going to be on the inside of the business, even if you're never going to trade at a firm, whatever. You need to know this stuff because it helps you understand what's going on. So what happens is what I described earlier. Sorry, I had to make a note. There's a woman on the telephone, and she reads off the number. In order to get this service, at the time, it's probably more expensive now, but at the time, it was like $6,000 a year. So for $6,000 a year, you could listen to the University of Michigan read its report. For an individual trader, probably not worth it, unless you're just huge and you tend to make a lot of money off of those plays. But see, for an office where you got 35, 40 traders in the office, or I think we had about 27 at the time, then it's like a drop in the bucket because if one of your guys, hits on one release during the year, it's paid for itself. And I'll give you an example of that right now. Every now and then, all the stars pull into alignment for you. It doesn't happen very frequently, but here's what happened on this particular day. On this particular day, there was an offer of like 270, I think it was, and it was just sitting there. And see, normally this was back if this was in the bonds. So this was back when bonds, when they thinned out, they didn't thin out to 100 by 100. They thinned out to like 10 by 20. And so there's this offer of like 270 just sitting there. And it's not moving. And normally, you'll see offers and bids sit right up to the moment of the number. So I'm thinking this offer is eventually going to pull before the number comes out. Here's the thing. The projection for the Michigan sentiment that day was like 94. It was way up there. The things were going great, So the projected number was 94. This is kind of how, too. This gives you an idea of the kind of mind you sort of need to have to take advantage of some of this stuff. Not like I'm a genius, but there's a certain mindset that allows you to kind of anticipate certain things like this. All right, so what I knew was this. I knew that if the number came out 80 anything, even if it was 89, the market was going to go up. Didn't know how far it was going to go up, but it was going to rally. There's no doubt about it was going to rally. Because anytime they missed a number by 4 or 5 points in the Michigan sentiment, it always caused a sharp spike. So the woman's getting on the line. I can hear it, it's getting ready to read the number, and this offer is still sitting. There's this 270 offer, and it's sitting right on the inside market. And so at the time, I was trading like a 60 or 70. I think I was trading 60. And so I had my mouse just right over the offer. I'm not going to do that because I'll end up clicking my mouse by accident and buying it up here. But I had it sitting so that there was 270 offer, and I was right at it. And the whole key to this is that I was waiting to hear the first syllable out of her mouth. So if the first syllable out of her mouth was A as an 8, I was going to buy it because the market should jump. She comes on the line, the offer doesn't move, the first syllable out of her mouth is A, and I click it. And about a second and a half after I click it, the market jumps 11 ticks. Hits a little bit of size, I dump it, bam. It was like 11 free ticks in 1.5 seconds. To this day, I have no idea why somebody would leave an offer of 270 out there like that. Whoever it was obviously wanted to get filled at that price. I don't know why they did. Now, what's interesting about this story, to me, is not that I made the call and I got the trade and great, market jumped 11 ticks. That's not what's interesting to me. What's interesting to me is that my really good buddy, who I still keep in touch with, who was a much bigger trader than me, he was trading like anywhere from 2 to 300 at that time. We went to lunch and he said, "Hey man, did you see that 270 offer sitting on the offer before the sentiment number?" And I said, "Yeah, dude, I got 60 of it." And he goes, "Yeah, I got the rest of it." Because he was thinking exactly the same way that I was thinking. And we didn't talk. I mean, we talked about did you catch a move sometimes, but we never had strategies that we planned out together. I mean, we traded a little bit differently. He swung a little more around numbers than I did, etc., etc. But see, during that moment in time, it was just the same mindset. We both knew the play there. The play was if it comes out 80 anything, the market's going up, and we got lucky and had this guy sitting on the offer right above us. And we were both fast. You got to be quick draw McGraw. I mean, as soon as we heard it come out, bam, we hit it, dumped it. I actually heard him cursing because he let it come back on him a little bit. Because it went from like 11 to 14 and then back to 9 or 8 or something. I think he made 8 or 9 takes on it, but didn't matter. He was swinging like 200. I share that story during these webinars just to give you another inside look. Again, sometimes you're just lucky like that. And I mean, it was preparation. It was like the whole thing where opportunity meets preparation or whatever, that saying. And it was that for sure. But I mean, I made, I don't know how much I made, or how much I got to keep. Prop firm kept most of it, but it's still a significant amount of money. And it's just on one move where you had the edge, and I had the edge because I could hear the number come out as she spoke it. I heard it at the exact same time everybody else in the world heard that number. So the only people who had an advantage over me were the people who already knew what it was. And supposedly they're supposed to keep those numbers under wraps, but we all know that that's bullshit. I mean, sometimes they do, sometimes they don't, obviously. So there's a story for you. All right, and I got one more. I'm going to tell it because it's the last day, and I don't even think I've told this story at the last 2 webinars. But there's somebody here who mentions this story. He heard it I told it the first webinar, and he likes it, and thought I should share it. I'm sure. I was trading with a guy at my firm who. This is a lesson in 2 things also, because I know I got some guys here that are trying to get on with some prop firms, or interviewing, or want to try and get on with a prop firm. And I know I got some people here who you still, everybody talks about discipline and management and whatever, but I mean this makes a really good point. All right, so I'm trading with this guy, and by the way, I see we're rallying, but I'm not doing anything. This is game over. There's a guy that sat next to me in my prop firm, and he actually was a pretty good day trader when he was on. Like, he could see moves, he'd take them, he had no problems firing. I mean, he would fire in a heartbeat. And sometimes he would manage his losers okay, sometimes not. All right? But if he could have been a little more patient and disciplined, he probably would have done pretty well. He just could not stay out of the chop like this. He would even be able to tell you, that this is, he would call it redonkulous. That was his word, redonkulous. Instead of ridiculous, it was redonkulous. So he'd be like, this is fucking redonkulous. I don't even know why I'm here. And then he would buy it and then lose 2 ticks and be like, that was stupid. And then, this is redonkulous. And then he'd sell it and then he'd lose 2 ticks. He'd chop himself out of 6 ticks in a 4 tick range. But on good days, he'd end up making, 20 ticks or something. Anyway, a guy was just very undisciplined and also liked to talk a lot, and he ended up talking himself right out of his job one day. So he got fired. And I call him Mr. R. So So Mr. R manages to land a job at another prop firm, and one of the reasons anyway I tell the story, I think it's a great story. Everybody I've told it to likes it, but it also demonstrates guys who run prop shops are not always the greatest businessmen. This is why, some people have asked me before about, why don't you go back looking for a shop, or why don't you go back to Chicago and blah, blah, blah. And they don't understand because they haven't been there. But I've been around enough to know sometimes you do have some decent traders at prop shops, and even the guys who maybe started up are decent traders, but they're not good businessmen. They don't really understand risk management when it comes to multiple individuals. They don't understand the ins and outs of the psychology and why you need to pay a guy a salary and all that good stuff. Okay, so Mr. R, he goes to this prop shop, and they start him out trading 10 lots, and he's doing all right. But see, here's the thing: they started him out at a 50-50 cut, and they're like, "Here's what we're going to do: we're going to give you a 10 lot, and we'll give you a 50-50 cut, and we pay out every month." How he got this gig, I don't know, and how they started him with a 10 lot, I still don't know. I guess because he took him some of his good sheets from where we were at our firm and showed him, look, I was trading 20s and 30s over there, and so they gave him a 10 lot. so one day he's in and out the market, and he's trading 10 lots, and the market moves a little bit against him, and he doubles up and he trades a 20 lot. And then he goes from being down like 3,000 to being up like 2,000 or 3,000. And he was like, because see, he thought he had a limit on his size, and he should have had a limit on his size. The guys who controlled the risk in this company were morons. But nevertheless, here's what went down. He's like, I think I can trade 20. So he does it again. He puts on a 10. The market goes in his favor. He doubles up to 20. He makes like another 1,000, 2,000, right? So now he's really on a roll, and he's swinging 30s and 40s. And early morning, he's up like 15 grand, 15 or 16,000. At this point, it occurs to him, shit, I'm up $15,000 and I'm supposed to be trading a 10 lot. They're going to know as soon. And here's the other thing: nobody was in the office. It was like him and one other trader and some guy in the back, and nobody was watching the screens. No one's keeping track of what anyone is doing. There's nobody in risk management is watching this take place. So what occurs to him? See, this is this guy's mindset. He's like, I'm up 7,500. They're probably going to fire me. I might get lucky, maybe, and they might come back and say no and put a limit on me. But most likely, knowing these guys the way I know them, they're going to fire me. So I'm up 7,500 right now. You know what? If I just swing this, I might be able to clear 20 grand, and at least have some money in my pocket while I go searching for the next prop firm to hire me. 100% true story, this is, okay? He starts getting into this position, and yeah, the light bulb goes on, all right. He starts getting into this position, and the market starts breaking against him. And at his peak, he is long 998 contracts. Hang on one second. So dude is long 998 contracts. And it's not until that point, because at that point he's really mumbling under his breath, and he knows like he's got serious problems, that the other guy in the room who's trading with him actually turns around and looks at his screen. I guess not. I even asked him that. I'm like, dude, why weren't you just long at even 1,000? He goes, I don't know, man. It was because of partial fills, I think. Like he was working 50, 100, 150. And it was just partial fills were getting taken off, and the market just kept ticking against him, so it just kept going down, and it wasn't actually that far against him. It was only like 6-7 ticks against him, but he had just hit it because he was so sure it was going to bounce. And he just kept doubling up. what can possess a person to do that is still beyond me to this day. At this juncture, the guy who's trading in the room, with him, turns around, sees his screen, doesn't say a word, gets up, walks straight back to the management office, and says, "No one is watching this guy. He's long 1,000 contracts." And the guy comes running out of the office, and it's like, "Get out! Get out! Get out!" And the best part of this whole story is Mr. R looks up at him and he goes, hold on, just a second. If you wait just a second, I can save you some money here." Because he thought it was going to bounce, Plus, he also he was right, because he knew that. I mean, we're talking about the treasuries back in the day, or the bonds back in the day, when that was a lot of size. He knew if he tried to dump 1,000 on the market right there, he's probably going to push it 3 ticks against himself, or more. So he tells the guy, he's like, hang on, I can save you some money. And this was in the bonds. This wasn't even in the 10-year. This was in the 30-year. The guy bumps him out of the way and pulls up a chair and just starts bailing. And the market, he drops the market like 3 more takes against him, 4 more takes against him. $120,000 loss on the day. The interesting thing about this whole scenario, there's lots of interesting things about it, is that there's nothing they could do. They were completely at fault. They had no risk controls on this guy. They had no credit limit set on him. He should have been blocked at a 20 lot. And of course, it's not like he had any money. The guy was flat broke. He's living in an apartment where he didn't even have any heat on. So there's nothing to be had. I guess I share that story because, one, I find it to just be a hysterical story. But two, that's exactly how guys blow up. He didn't even have the money to do that, but that's exactly how guys who do go on a roll blow up. You might have a guy who comfortably can swing 100 or 200 or 300, and he's, banging around the markets and doing pretty well over the course of a year or two. And then one day, he loses his shit, and he's long 1,000, and he wipes out his entire account on one bad trade. No, I'm pretty sure. Although I can't tell you for sure. I don't know what this guy is doing. I know he did manage to get a job at another firm. He had to, but his name got out, and he had to go by his middle name when he was applying for jobs. He never used his first name again when he was applying for jobs. So I do know that he did manage to get on at some other firm at one point, and then that didn't work out, and I lost track of him after that. I don't know what he's doing now. He was crazy. He used to be a mascot. He would be the guy who was a mascot at the college where he went to in the football games, run around in the outfits and do all that funny stuff. And the guy's a character. He's awesome. He's just hysterical. He cracked me up every time I talked to him, but no discipline whatsoever. Just no discipline. Okay, there are my stories. I got a couple questions here I'm going to answer. I didn't get too many though, so we'll get through them, and I'll see if anybody else has some stuff they want to talk about. Temporary insanity can definitely shoot up there. Let me answer this real quick because these were I asked while I was telling that story. All the days where I've been staying out of the market, kind of you're worried that you might be just firing in and not recognizing that it's sort of a bad market. My general rule of thumb, and it didn't even happen today because I was lost. But my rule of thumb is 2 things really. It's one, you're just not seeing it. Like with me today. I can't see it. If you're just not seeing it an hour and a half in, you should probably stay out. 2 is if you end up making 2 or 3 losing trades in a row, you should always step back. And at that point you need to reassess, am I making bad calls here, or is it like this? Am I seeing refreshing and iceberg orders go off, and then the market's just not going anywhere? See what I mean? So that's the difference. So you see, like right there, I mean, you see some size absorbed at 23, but are you going to sell 23s? I mean, you can maybe make the call because you've got this profile level right here, but you were also seeing that below this. And then it goes bid, and then nothing happens, and then it just sits here. So it's recognizing that while you might see a little bit of action that you think is good, how does the market follow that up? Does it follow through on these trades that you're making where you think you should be right, or does it just sit there and go back and forth and back and forth? And the volume's off today. You can see that the total volume is off. We're usually over 500,000 by now, or more, 600 to 700,000 some days. So those are the main things you want to look for. Kind of how is the volume playing out, and this is a good one. Do I think the activity shows up on the tape if it's obvious before the market makes its move? Sometimes yes, sometimes no. And I realize that's not like the greatest answer, but it's just the truthful answer. Yeah, sometimes it is obvious. Like to me yesterday when I was in that short trade, I gave it a lot of time where it wasn't obvious. I couldn't tell if it was going to break those lows or not. And then on that last push, when it started to backtick against me, to me it became obvious that they were not going to crack the lows. I didn't know how far it would retrace, but it was obvious that they're just not going to do it. It just is not going to happen, and so I've got to get out and stay on the side, and then maybe try and get back on board if it gets back down there. So, that's, again, sometimes you're going to see it, sometimes not, and sometimes you just got to jump on board, like particularly like that S&P yesterday. I mean, that, with the S&P rallying like that, at some point, if you want to play it, you just got to hit it and hope you don't hit the high. I mean, and you do that in the bonds sometimes too. You just got to get in and hope there's that follow through that you're looking for. Which brings me to another thing on the S&Ps. You know what? I know I still got some guys in here who are S&P traders, and continue to trade S&Ps after you leave. That's great. I hope some of the stuff we've covered has helped. But what I find is, even in the S&Ps, if you're going to trade them, you still have probably got to make a lot of short-term trades. I think the reason most guys trade the S&Ps is because every now and then they catch a move like that one yesterday, and they feel all ecstatic inside because they make 15 or 20 ticks in the trade. But I don't know that they keep track of how often that happens and how much they give back in the meantime. And as we've seen many times in the S&P, the market only moves 5, 6, 7 ticks and then retraces and then goes back and then retraces. And even if it makes, like somebody was mentioning, it makes another range extension, so it goes between 10 to 15 to, it's trading between 10 and 15, and then it's trading between 14 and 19, but even trying to play along in those areas, there are going to be times when you just run into a complete wall, and it snaps back against you 5 or 6 ticks. So I still think, you've got to give it a little more room sometimes, but not always. I mean, and I demonstrated that yesterday. I knew I was wrong in those trades and blew out and took I think a 2-tick loss and a 3-tick loss, which ended up being the right move overall. All right. Well, what I like to see here, when you're talking about the volume at the inside, earlier what I pointed out was that you were seeing, like, there was 2,500 on the bid, and then the market would go offer above it, and I mean normally that 2,500 will drop to 15, 16, 1,400, and then it'll trade and it'll sit there, and there'll be there'll be market makers and people at every price. What we were seeing was that 2,500 was dropping to 300, and then they would sell it, but then 1,000 would trade, but then it would sit on the offer. And then the next bid would be 2,500 bid, and it would drop to 300. So you don't want to see those really big back and forth moves where it goes from 2,000 bid to 300 bid to 600 bid to 3,000 bid. You want to see anywhere from 700 to 1,500 kind of at every price, and you want to see it trading. It's not always going to happen, but you don't. I mean, that's great when you're on the right side of moves like that. But it tends to be great around areas where they're breaking down. When it's a choppy type market, what happens is that happens like 2 or 3 ticks. So they drop 22 halves, 22s, 21 halves, and then the offers do the same thing. The offers drop away, so the market just rebounds right back up to 23 again. So you get this nasty back and forth that's very hard to trade as a result of the volume just not being there. Or you see it go back and forth and it trades 6,000 at one price and it just doesn't mean anything. It's just guys working orders at one price and a lot of scratches and computers that are trying it, doesn't work, to get out. Try it, doesn't work, get out. Try it, doesn't work, get out. So you see a lot of volume trade, but it's not because somebody is building up a position to try and make a run. You know what I mean? It's just back and forth nastiness. Somebody asked me this, so I'll answer it. The best trader I've ever personally met is that guy who I told you bought the Michigan Sentiment number with me. He's not. Well, he personally he's not the biggest I've ever met. He's probably was the second biggest at his peak. I mean, he's traded as high as 1,000 up in the 10-year. He made a lot of money. It was just really good. He had his swings. I mean, he had years where he'd be down, come April, May. But then he would kind of pull it out. He wouldn't be down a lot. He'd be down maybe 40, 50, 60,000, something like that. And then he'd turn it around and make $500,000 or whatever in a couple months. The best trader I ever personally met, but didn't know him for long because I left. He was a kid that came into our office after I left. I think he was actually in the class that was being trained whenever I was leaving. And he went from 0 to 20 million in, I think, 4 years. I think he ended up making $2 million his second year and like $5 million his third year. And it was unbelievable run. I mean, he was just a fucking monster. He just read it, and he would move size, and he 1,000 up, 1,000. Yeah, he was scalping, straight up scalping, and you're welcome, man. If you're taking off, I'll get you all the videos, this weekend, and write me if you have any questions. So yeah, he was a scalper like the rest of us, and he would make some, he would hold on to trades sometimes and ride them and whatnot, but he was swinging big, and I think that's what the number is, according to people who knew him. It was somewhere in that neighborhood. Again, the firm kept a lot of that. He was able to renegotiate his contract though because he was so good. The rest of us, they did once they started to lose people, they worked with him, and we're like, no, we'll work with you on this. He fucked up though. He took an overnight trade one time and took a massive hit, and there you go. He did something that he knew he shouldn't do. And I mean, he still got plenty of money, but it was from what I understand, it was a major hit. That he took, like, big time. But he's got to go down as the best I've ever personally met. I mean, I've never personally met anybody else who's made $20 million trading, from nothing. I mean, it's not even like he went into a hedge fund where they gave him $100 million. I mean, he literally started out as a one-lot trader. 1 to 2 to 5 to 10 to 20 to 100 to 1,000. I mean, that's how he went up, so... All right, here's a question I got from the overnight or in my email here, and I think this is a pretty good one. It seems this gentleman is saying that it seems to him like there are two possible mindsets, which is one is going with the trend, going with the momentum. The other one is looking for your fading spots. It seems as though an order flow trader could, choose either mindset. His choice affects his bias. He's heard me say that usually going with the momentum can be the safest. However, fading is obviously a good strategy, as you've seen. I think I've made my money fading. Well, maybe not. I haven't made much this webinar, but a little bit that I've made, I think I've made fades, and except yesterday. And so he's saying is he's caught himself being blindsided, trying to work those fades and getting run over. So the question is, how do you view the market most of the time? Does whenever I say trade what you see, does that imply that I possess the flexibility to flip from one mindset to the other based on conditions? He finds this very hard to do, but it's probably a characteristic of good traders. Are either one of these mindsets preferable for viewing the markets? I try to be as flexible as possible. I do have biases. On a day like today, kind of my bias, not today really. Honestly, today I just couldn't see it. But there was another day this week, I think, or whatever day it was, where we opened up and we were trading right near the highs, overnight highs. And then the market started to slide off, and it hit like a level, and then it got through that level, and it kept on sliding, and then went to those lows. I don't know if you guys remember that day or not. On a day like that, my bias prevents me from taking the short trade. See, it's like what happened was is I was biased because we were trading towards the highs, and as it was falling back, I was looking for a pullback level, but really at a point I realized this could go in either direction now. The problem was, I didn't really transfer over to they're crushing this, I need to go short. Today, even though they were doing that, I wasn't feeling it. On that other day, I was starting to see that they were crushing it, and I never took a short trade. I basically talked myself out of it the whole day based on the open. So that varies from day to day for me personally. In general, though, yes, I try to be very, very flexible about what I'm thinking. You do have to have a little bit of a mindset in terms of where you think that the next direction is, because you can't just be playing for ticks. You do want to try and take trades where you think, if I'm right, I should get at least 2 to 3 ticks out of this trade, and maybe it'll go more. But there'll be times when, actually what happened up here the first time, which was I had a bias to the upside, and I actually tried to hit the 25 halves, and I was just way too slow. They were gone. They were already trading 26 halves. So at that juncture, I canceled my order, and now I'm looking, should I buy 26 halves? But then I think I saw like 7,000 trade there. It was like 6,900. So as soon as I saw that, I saw it sweep, but it only swept 2 ticks. And then I see 6,900 trade. I don't take the long trade at that point. See what I mean? So my flexibility comes in more in situations like that. I'm trying to trade what I see, and what I was seeing right here was a market that was probably going to snap through the high, and I was right. But then it didn't continue. So as much as I wanted to go long and kind of hope that it was going to go up, what I was seeing was a market that swept 2 ticks and ran into pressure instantly and was probably going to fall back. The problem is, once it falls back 2 to 3 ticks at that juncture, I don't really know. See, at that point, there's no way for me to tell if it's going to go back to 26 half or if it's going to go down to 23 half. So I try to be very flexible at that point. Hold on one second. All right, sorry about that, garbage truck. So yeah, I mean, you do well. You have to have an opinion, but you can't have an opinion to the degree that it overwhelms what you're seeing with your own eyes. I think that's probably it's really that simple. It's you of course you have an opinion that the market's going up or down based on something, but your own eyes are going to let you know what's going on. I mean, you might be in a trade and you're thinking, well, we're at the bottom of a profile level. I mean, I'm buying it. I saw buying here. Why isn't it going up? It doesn't matter why it's not going up. What matters is they're hitting the prices underneath it now. You know what I'm saying? So you have to acknowledge that you're wrong for the time being, that you stepped in at the wrong price, or maybe you stepped in at the right price based on your opinion and an iceberg order, but the iceberg order is getting overwhelmed. It just like I said on that intermediate trade that I make, or that last trade on my intermediate video. Excuse me. I made the call. I mean, I had buyers behind me, and I had a refreshing order and everything else, but it just they ran me over. What are you going to do? So it's kind of important to be able to adjust based on what you're seeing. It's like I said. I mean, if you buy 10s, sell 8s, buy 7s, sell 6s, obviously you're on the wrong side. I mean, the market's moving down. Um, so yeah, you do need to be very flexible, and also keep in mind, like, see, my particular style, and you kind of have to do this as a retail trader or someone who doesn't have a seat. I'm not constantly in and out, obviously. I mean, when it's busier, I'll make more trades than you guys have seen, but I'm pretty selective. I make a couple trades a day, two to five trades a day, probably on average. These other guys who are moving around the markets, they can afford to be in and out a lot more. Even if maybe they have an overall bias to the upside, they can afford to short and scalp one or two ticks and then turn around and reverse and try and jack it back up. I mean, it's not just guys accumulating for one run. There are guys in and out all day long looking to take advantage of any discrepancy that they see in this market. So, um, and see, those guys aren't biased, and I guess that's where I'm going with it. So if those guys aren't biased, you can't really be biased either. You've got to be flexible as well, because they're going to make decisions based on tick-to-tick information sometimes. And then that tick-to-tick information or tick-to-tick trading can lead to a bigger move in one direction. So yeah, I think it's very important to be flexible and very important to recognize what you're seeing with your own eyes. Don't question yourself on that. I mean, and you can go back afterwards when you're out of a trade and see, did I really do the right thing here? Was this a legitimate trade, or was I being impulsive? And I think if you're honest with yourself, you'll start to realize when you messed up and when you made a good trade, whether you win or lose. Win, lose, or draw. With time, if you're really honest with yourself about where you got in and how the action was playing out, you can see it. That goes back to like that trade I showed you guys. We reviewed a couple of days ago where I got ran over on the Treasury. It's my sample trade on one of my videos on my YouTube page. I mean, I'm totally honest with myself when I trade like that, and I'm like, I just made a stupid trade, and I can see that. So all I can do is recognize it and try not to do it again. But you've got to at least acknowledge it and recognize it and admit it to yourself so you don't continue to make the same mistake over and over. See if I got... I didn't really have too many other questions, to be honest. couple people wrote about that, the S&P versus the Treasuries, and again, just to touch on that, you clearly see the difference in the two. I would hope. I've converted more than one person, but I'm not saying you need to. I mean, everything that I've showed you is applicable, but the S&Ps are just a little bit different. I think you can make plays in the S&Ps, obviously, for bigger momentum moves. You can't hesitate in the S&Ps like you can with the bonds sometimes. You can get a little bit better look in the bonds. With the S&Ps, you usually can't hesitate. You just got to step up and take it. I found over time that the Treasuries tend to be an easier trade for me, personally. Other people don't like them, But again, my advice is pick a product and stick with it. If you really want to trade one or the other, pick that one and just go with it. Don't swap over. This is a interesting question. Hold on one second. By the way, to answer that earlier volume question, see, this is what I'm talking about. See how this is built here? So this has gone from like 40-something thousand to 72,000. This is at 62,000. So you're seeing a lot of, it looks like a lot of volume is trading, but it's doing it in between three prices. You don't want to be involved in that typically. It's just not going to go anywhere, as we've seen. So I think I just sent this, but I don't remember. I'll send it again. With regards to personality traits, with most of the successful traders that I've met, are they more the risk taker types, or are they the risk averse types who like to protect their capital above all else? Honestly, they're the risk taker types. I know some people don't fall into that category, and I'm not saying you have to be a madman. Someone actually asked me about this week, as a matter of fact. I rode a bull once, like a live bull, 1,500-pound animal. I actually got on the back of a 1,500-pound animal and rode it because I'm an idiot. Or I was an idiot. I would never do that again, but, I'm not saying every day trader in the world has ever ridden a bull, but like most of the guys I know, they're globetrotters. They like to go to other countries. They like to see bizarre things. They like to snowboard. They like to scuba dive. They just, you can't be stupid about it. Like the one guy who made 20 mil. I mean, you can't make $20 million day trading and then risk millions of dollars on an overnight trade. That's stupid. But yet there has to be a certain disconnect from the money in order for you to be able to trade it correctly. Because if you don't have that disconnect, you're never going to fire. And if you do fire, you're never going to swing the kind of size you need to swing to make any kind of decent money. You know what I mean? So you don't have to ride bulls or bungee jump or anything like that to be a good trader by any means. And there are some other guys, I'm sure, they're in the quant field. Your programmers, they of course are the opposite of that. They're looking for risk-free arbitrage or spreads or whatever else, but that's a whole nother ball game altogether. Whole nother field, So, and even those guys have got to be able to manage their risk properly. I know of a couple of firms that have had major swings, and they were tight players. They were always trying to. I may have told the story, I don't remember, but there's a firm that I know. They're huge treasury traders. I mean, they trade spreads. They don't trade outrights. They move a massive amount of volume in the treasury markets. And they had their strategies, which were not automatic, but they were somewhat automatic in terms of how they implemented them, and they worked within the bell curve, standard deviations, etc., etc. And when they had the meltdown in 2008, they got worked. And see, here's the problem. They got worked because everybody who was doing anything did it in the cash market. So they started to see the spread blow out between the cash and the futures, and they kept. I don't remember which way it was, which one was buy, which one was sell, but for sample purposes, we're going to say buy. The spread was blowing out where the cash was rallying and the treasuries or the futures were not. So they started selling cash, buying futures, anticipating the futures were going to catch up with the cash and the spread would come in. And it didn't. It just kept going wider and wider and wider, and they kept adding to their position. And they could afford it, but they took a massive hit. And I know this because I know somebody who worked there. What happened was, the global meltdown was so huge during the crisis there with the housing bubble bursting and everything else. Everybody who had to move real size moved it in the cash market. So nobody was buying futures. They weren't interested in the futures market. They needed to go now. They needed to liquidate stuff now or buy stuff now, and they needed to do it in the cash. So I guess where I'm going is, even if you're like the risk-averse type and you have tight strategies and you're working programs and you're a spreader, and even there, you still got to be able to swing, because they had made tons of money over the years and they could afford the loss they took, but you still got to be able to risk the money. You know what I mean? And actually, a big part of that was that one of the guys who ran the firm, he was a swinger. Like a lot of the guys were not, but he was. So he would get them involved in oil butterfly spreads and things like that, swinging for millions of dollars. Oh, what happened there? So, if this question, if you're long at an iceberg, the bid drops, and you fully know that it might go a tick or two and then rebid it, should you hit out right away or wait and see? That's just going to be something that kind of comes with time. I mean, it depends on the scenario. If it's a solid iceberg at an area where it looks like it's going to bounce, you might just have to hold it. Now, sometimes what happens is it'll bounce, and then I'll get a feeling that they're going to crack it, and then I will scratch it and wait for it to go a tick or two lower. But if you're already in it, and you think it might go a tick lower or two, but it's probably going to hold, you can't really bail out for a one-tick loss, because you may end up hitting right into the spot where it bounces. I mean, you already saw the iceberg, you're already in the trade, and it's already offering your face. And if you're right, it's going to snap back on your price pretty quickly. So at that juncture, again, it all depends on the setup, but at that juncture, you're probably going to have to wait and see if it gets through you by 2 or 3 ticks. If it really starts to go at that point and they can't jerk it back to your price, it means the iceberg is probably going to lose the battle at that point in time. Then you can bail out and stand aside. I am not Johnny Knoxville. I was with a group of guys and we were going bull riding, what are you going to do? You going to say no? We're going bull riding, man. Let's do it. Idiotic is what it was. Flipper said that trading is a game for him. He does not think about the money. What is the game about? Okay, first off, let me tell you something right up. He thinks about the money. Anybody who says they don't think about the money is lying. The reason he says that is because of what I'm talking about. When you're actually in the trades, when you're trading it up, at that point you can't think about the money. At that point, it's what's the right call here? Should I be long? Should I be short? Should I be flat? And you just trade it up. And you trade it within a size that's comfortable for you. When the day is over, he thinks about the money just like everybody else does. Trust me, he just has a very high risk tolerance, and still likes to play the game and is still in the game. I guess he made his 100 million or whatever, and would be bored if he stopped playing. I don't know. The game is about playing it right. The game is, do I want to be long, short, or flat? And don't think about the money when you're making those trades. You think about the money either when you have a drawdown that's serious because you're making a lot of mistakes, or you want to take some money out because you hit them and you're going on vacation, or you need to reassess. You've been trading for 6 months or a year, and you got to kind of look back and say, all right, what's the bottom line here? How am I doing? What's going on, etc., etc. But so that's where the money comes into play. But yeah, when you're making a trade, you can't think about the money at all. Which is why you determine a size beforehand. What kind of size are you comfortable with, and stick with it. That's pretty funny. This is funny. Someone was trading in an arcade. A guy had the Boone Bobble ladder swapped around. He didn't realize which one was which, so he was trading. He was trading more size in the Boone than the Bobble. I never have any trades open when going into any economic number. That is correct, sir. That is a personal decision on my part. I don't have that kind of risk tolerance. And I've seen numbers miss so huge, and the kind of move that follows it. You could wipe out your entire account in one day by doing that. You know what I mean? In theory, you would have the size on that wouldn't happen, or maybe you would negotiate it. But just as an example, you might be a great day trader who grinds it out 3-4 ticks at a time, and maybe not very big, but you make 150,000 on the year, and then you go into a unemployment or something, and you don't even have big size on, and you think that you're safe. You're like, well, worst case scenario, I'm only going to lose $4,000 on this trade, and instead of losing $4,000, you lose 20, because you didn't anticipate that the market could actually go straight up 90 ticks in one direction. Now, that doesn't typically happen except around huge events like unemployment or something. But look at those guys who were caught the first week of this webinar, the FOMC meeting. That the FOMC comes out, a couple of guys punt, and they're instantly looking at a 20 tick loss. If I want to do that, man, I'm going to Vegas. You know what I mean? It's like, at least I'm going to get some comps out of gambling like that. If I don't think my odds are any better than 50-50. Yeah, sometimes it can be safe to trade after a number almost right away. If it doesn't miss by much, or if you see something and the volume comes back in. That's the real key. See, where you get worked and then around numbers is when your volume is very thin, and even though you see some trades going off, you try and go with, like maybe you see somebody hammer 2,000 into a price, and you see this offer drop away right above it at like 23, maybe drops to 300, and then no one taps those 23s. So you have a bid of, let's say, like right here, actually like right here even. Let's say you're playing right after a number and you catch 21 halves and you got this bid of 2,600. During a normal day's action, you're going to be able to scratch that trade if you want. You know what I mean? They're almost guaranteed. During number action, they'll hit 22s, no one will tap 22 halves, and then the market will sweep straight to 20. So you'll go from being in a 1 to 2 tick winner to a 3 or 4 tick loser in just a matter of no time whatsoever. So I like to play when I stop seeing that happen. Basically, when there's a little bit more size than that. I don't want to see them trading up 200-300 at every price, and bids and offers pumping and pulling, and and the market sweeping 3 or 4 ticks in each direction. Or if I take a shot and it doesn't go really quickly, I usually scratch. It's that kind of thing. Man, what the hell, man? What's going on with the green screen? All right. The floor is open, ladies and gentlemen. Last day, so if you got any questions, please feel free to fire them off now. Or if anybody wants to ask me a question, I'm fine with that, I'll turn your mic on. So there's no real correlation between them pumping it up an hour before the number because they know the number will miss. Not an hour before, no. I mean, if anybody knows the number's going to miss big, they usually won't start making that play until, usually it happens in the 10 minutes leading up to it. Even with auctions and whatnot, you start to see it happen going into the auction because guys know that you may have some back and forth shot prior to the number coming out. So unless they have heavily inside information, they're not going to put on a big position too much before the number comes out. Although the other day it was kind of like what I was talking about. They were selling that market off, and it sure did seem like they knew what was coming. You know what I mean? I couldn't prove that, but it sure is strange that happens as frequently as it does. I will, yeah. I'm gonna work on this advanced webinar thing and see how much interest there is in it, and I'll get an email out to you guys later in the year. It'd probably be in January or February, yeah. Here's something for anybody who's interested. There is a Skype room, but there's not a whole lot of back and forth anymore. Like, what happened is that the conversation was started with some of the original webinar participants, and I mean, there's 20-something people I think that are part of the room, but now there's only like three or four people who regularly talk, and two of those people they trade Eurex, and one of those guys I think has dropped out for the time being of the room. But I would be happy. I mean, I think I've already added a few people from here to the room. At any given time, just you can see there are people online on Skype. Just log in. I know some people they don't want to be the first ones to make a post or ask a question or whatever. And you may ask a question, and you may not get any answers. I mean, I can't guarantee you, but I pop in there every now and then. I don't pop in every day, but every couple of days I usually will pop in, and if somebody makes a comment, and I have a comment, I'll leave a post on it or share a little something here and there. So again, yeah, if you want to be added, just send me an email and let me know, because I know I've already added some people to my Skype, but I don't. Some people have different Skype names than their regular names. You know what? Let me send this out here, and I'll take a poll right now, just out of curiosity, because I have had some requests for this. Is anybody in this room be interested in doing a live seminar in Chicago in the summertime, where we'd probably run it for a week? I'd bring in one or two buddies of mine who are also traders, and don't quote me on this, but I'm 90% sure I could get you down on the CME floor for an hour or so. You might have to go in groups. They're not too big on taking in 20 people at a time or something, but If it was a smaller group, I could probably work in 3 or 4 people at a clip, and it's a novelty thing. It's not really like, I don't know how much you're going to learn from going to the floor, but there are some guys who would be interested in doing live stuff, and you can kind of tailor the training to people's personality. So if you are interested, just let me know. Yeah, that's the only thing. It's going to have to be a little more expensive, and that's one of the reasons why I've held off of doing it. It's like, I get a lot of I get more participants for webinars, obviously, because it's global. I can talk to people in Russia and Hong Kong and Europe and South America, and we're all from our own homes. Nobody has to go anywhere. I don't have to go anywhere, and so we can do this for 3 weeks, and it's cool. It's fine. It's great. It's awesome. And I think you learn a lot. I think you get the videos, etc., etc., etc. See, with a live seminar, it's not going to be the same. Like, for one thing, you're going to be limited to just that 1 week of action. So I would certainly try to plan it around a week of numbers and releases, and no vacations, obviously, or whatever. But you still are limited to just that 1 week of action. And you're basically going to see probably the same kind of trading that you see here. The difference is, we can interact in person, and I can kind of chat with you maybe about your own personal situations, and I can introduce you to a couple more traders who might also be able to help you or share some different strategies with you. But the cost is a lot more, because I got to fly to Chicago. If you don't live in Chicago, you got to fly to Chicago. You got to get a hotel room. I've got to rent out a conference room. So really, that's why a lot of them are too pricey anyway, because the information they sell is shit. But you can't really run a seminar like that for less than like $1,500 or $2,000 a head. Probably at minimum, and just due to the cost involved in setting it all up, and also you have the additional cost of travel time and hotels if you don't live there. Yeah, well, being able to show you my screen wouldn't be hard. I could set up a projector and just run or a TV. Actually, it'd probably just be a flat screen. Just set up a flat screen in the front of the room and connect your computer right into it, and you'd have it on a 45-inch screen with surround sound, baby. We blast some music in the background. Not really, but just throwing it out there. That's kind of the thing, Doug, I know you've asked before. I've never had enough response to really be into it. But if anybody is interested, it would be up in that range, though. So you're probably talking around like $2,000. So knowing that ahead of time, if you're interested, shoot me out an email. If not, I completely understand. Yeah, I know. It's just really difficult unless you live in the Chicago area or surrounding, maybe like Indiana, Ohio, or something like that. It's a difficult trip. And like I had a guy one time. He asked me about that, and he lives in Dubai, and he said, would it be worth me? I mean, if you do a seminar, would it be worth me flying from Dubai to Chicago? Oh, really? You live in Dubai too? Cool, man. And and I'm like, no. It just not really. Not in terms of trading education. In terms of trading education, you're probably going to get more with me for 3 weeks on the webinar. You know what I mean? If you want the experience, of going to Chicago, and we can kind of chat and really personalize maybe some things to you, and see the exchange and go down the floor. I mean, if you want all that, then sure thing. But I would not advise flying from Dubai to Chicago just for pure trading information. I mean, it's kind of an overall total experience type of thing, you know. Right. I mean, you can line it up like that if you have friends or family, or you just want to take a vacation to Chicago. And Chicago is great. Take care, dude. I'll hit me up if you have any questions anytime. Um, Chicago is an awesome city, wonderful city in the summertime. I mean, just fantastic restaurants and great energy and live music and everything else. You know, volleyball on the beach and stuff like that. So it's a great place to be. Okay, guys, let's if you got more questions or want to chat or something, hit me up here. Yes, the weeks that I do not trade. I do not trade Thanksgiving week. I do not trade, like, for example, this year. Let me bring up my calendar and I'll show you. Or I'll tell you. I mean, I'm looking at a different computer here. This year, Christmas falls on a Tuesday. So I actually most likely won't trade. My last day of trading will be December 14th. Because the week going in is still the 17th through the 21st. And then the next week you have Christmas. But most likely, like the 19th, 20th, and 21st, the market's going to be just dead. Dead, dead, dead. And maybe all week. I just know this from having traded for years. So I will probably stop trading December 14th, and I won't pick back up again until January the 7th. You know, that whole week of New Year's also, I take off. And even sometimes the week following New Year's sucks as well. Just depends. But I take those weeks off. I don't trade around Easter. Don't trade the week of the 4th of July usually, depending on where it falls. And yeah, any days where you are emotionally compromised. That's correct. You should definitely avoid trading if you're having issues at home or if you're sick or something's wrong. Anybody else? I'm here. You got me. Why you got me? Why you got me? That's about as southern as you can get right there, isn't it? If it wasn't obvious before today, it should be obvious that I grew up in the South. Farming community. I do not. I don't mind follow-up email questions. You know, feel free to send them anytime. I try to answer them as best I can. You know, sometimes secret. Sometimes you can't really answer the question in an email. You know, and so I do my best to try. But yeah, please don't ever hesitate to write me anytime. I check my emails every day unless I'm on vacation, and then I'll let you know. But I will absolutely get back to you. And if ever you send me an email and you don't hear from me for like 3 or 4 days, it's probably because I'm like this year we went to the bottom of the Grand Canyon for a couple of days, so there was no computer. But I'll get back to you. You know, and if you don't hear from me in a week, just send it to me again. I'll get back to you. It's because I missed it. Why August? August is just a very slow time for the markets. Lot of traders do like big vacations in August. Basically, they end up, you know, your guys in New York go to the Hamptons. They go to Europe. Guys in Chicago, same thing. Only they don't go to the Hamptons. They go to the West Coast or whatever. You know. So, although you can get some decent movement, I mean, I traded a couple of days in August this year, and it was damn sure a lot better than what we saw most of the days here in September. Um, in general, though, it's pretty bad, and any trader will tell you that. Actually, from Florida. I'm from Florida, but I'm from the central part of the state, and out there it was basically a lot of Georgia natives kind of founded the area where I grew up, and so that accent carried down. And now I'm one of the few remaining Florida natives. Um, a lot of people down here on the East Coast, anyway. From Miami to West Palm Beach is almost all people who have moved here. Are there any trade secrets? None. I'm not keeping any secrets from you whatsoever. If I had any more to give you, I would. I was at the firm back in 0304. So that's how far back we're going. And if you bring up a chart or a history and go back and look at like the daily ranges that were taking place back then, you'll see exactly what I mean. I actually started in 02, so going back 10 years. Yeah, it's good. It's good. Like August is good to take some time off. It's like anything else. You gotta take a break at times. No, this is a good question. If someone can prove that you've made money or whatever, do firms seek you out? Rarely. If they're seeking you out, they're seeking you out because they want commission dollars. It's a weird, weird thing. Um, I don't know why it exists or why it's the way it is, but I can tell you from experience that I went in to interview at firms and I had statements to back up my claims, that showed large quantities of money being made, and I got turned down. I got turned down at 3 places, matter of fact. And it was predominantly because they didn't want a scalper. They didn't care that I had made money. It was totally irrelevant to them. They wanted to know what I knew about spreading, what I knew about the yield curve, what I knew about macroeconomics, etc., etc. Um, and they weren't interested. So there it is. Don't be an idiot. Yeah, that's the main secret. Don't be an idiot. When you know you're being an idiot, cut your loss and get out. No, I'm not a member. I don't have a member on an exchange. It just my particular life experience that has taken place just never sort of led to that. Essentially, in a nutshell, I won't go into all of it, but combination of various things. Between leaving Chicago, I had a family member who got real ill for a couple years, and things like that kind of came into play. Um, would I go back to a prop firm? Probably not, honestly. Not this. And I mean, maybe if someone came along and they were totally legitimate. But I've had so many negative experiences with them because I did actually try to put together deals on 2 other occasions, and I ran into people who weren't good traders trying to tell me what to do. That's basically what happened. I ran into people who didn't understand didn't understand the world of scalping very well, and they weren't willing to. I mean, I was risking more money on my own than they wanted to back me with. Basically, is what it came down to. You know what I mean? So it's like, what's the point? One of the deals did have good commission rates, but it didn't work out. It fell through. I've never had a good experience with them. And the one that I worked for was a good experience. That's where I learned, and whatnot. But even with those guys, my experience was if you become a star trader, we'll give you a better contract and a better cut. and I turned into one of their top 4 traders, and they didn't want to give any of us a better cut. You know, they reneged on their word, and just refused to compromise. So, what are you going to do? There is no one particular thing here. What is the most important thing? It's all of it. And it's funny. I kind of totally unrelated, but not. There's this, for anybody who lifts weights, and maybe nobody in here does, but I was just interested in the whole physical aspect of bodybuilding and weightlifting at one point, and I weigh like $105, so I'm not big at all. But I found it kind of fascinating, the changes that your body can go through. But I heard like this one guy who was Mr. Olympia. His name was Dorian Yates. He was doing an interview, and somebody was like, "Yeah, what's the most important? Is it number of reps? Is it the amount of weight? Do you go heavy? Do you go light? Is it diet? Blah blah blah." And his answer was perfect. He goes, "It's 100% all of those things. It's 100% how big you lift, 100% how many reps you do, 100% your diet." And then trading is the same way. It's 100% of all of it. It's understanding the game. It's recognizing types of orders. It's having the discipline to fire, having the discipline to get out when you know you're wrong. It's all of it combined. It's one big organic reactionary, I don't know, thing. I lost words there. But math was not his strong point. I bet you wouldn't say that to him if he was standing in front of you, though. Dude was, a monster. He is a monster still. This is a good question. You asked about buying or leasing a seat. Is it possible to have more than one person trading from that seat? No, it's not. Not unless you rig it. One person has to buy the seat. It's got to be under your name, and the account that's being traded has got to be your account. Now you are allowed to lease that seat or allow someone to trade under you. But as my understanding is that only one of you at a time can be executing orders based on that seat. So yeah, if a couple guys wanted to go in and kick down the money and then swap off when they were using it, you can do that. But it's all going to have to be under one name and one account because you gotta have a membership. Now leasing a seat is a little bit different. You can lease a seat. It still will have to be under one name or a company name, but it can still only be used for one account, as far as I'm aware. What I would recommend is if that's something you're seriously contemplating, you can contact the exchange itself. Don't contact your broker. A broker can help you sometimes with the application process, but there are individuals working at the exchanges who are responsible for this on a day-to-day basis. That's all they do, and they're actually very friendly. I've spoken to a person before, so just give them a call, shoot them an email, whatever, and somebody will get back with you with all the pertinent information about that, and they'll tell you exactly how it works, exactly what's involved with the application process, the cost, and everything else. Just for sure, just if you're interested, contact somebody there. Everybody wants to be a prop trader because they perceive it to be different than it is. I mean, yeah, if you get in with a real firm that's paying you 30 or 40 grand a year, or some even pay more, but their payouts are less. They give you size, they give you the right commission rates, they give you you can sit there for a year and a half before they fire you. Obviously, that's a wonderful, wonderful, wonderful deal. Those places are so few and far between. It's ridiculous. And they're actively recruiting right out of college. I mean, trying to get hired as a prop trader above the age of about 26 or 27, good luck. Once you've hit your 30s, I'm not saying it's not possible, but to get into a firm like that, like a real legitimate firm in Chicago or London, something like that, you're going to have a hard time. Um, so Oh, is that this weekend? I might actually watch that. That's this weekend coming up, Mr. O. Those guys they're just beasts, you know. And most of the guys when you go to the gym, they're actually not beasts. I'm getting off topic, but there are some big guys. Every now and then, though, I'd walk into the gym and there would be like a real bodybuilder in there, and they're just freaking massive. You know, they're as wide as I am tall almost. Yeah, if you wanted to work on getting a seat or a lease for like a company, you would have to you wouldn't have to have a fund, but a hedge fund, but you would have to have some kind of corporate paperwork in place or an LLC in place, and then it would still. I think though even then I think it has to be traded under one name. Even then, you know. Yeah, well, with regards to what do you do with your money once if you end up making it, pull some of it out and stick it under your mattress. I mean, that may sound like bad advice, but maybe not your mattress. Maybe put a vault in your floor that no one can access but you. I honestly no, it's not good for your back. You're right, it's not. So it's not your mattress. Don't put it under your mattress. Put it getting a sell off here. Put it in a vault. I think in the next couple years you're and I could be wrong. I think you're going to see some bad things go down. Like they've managed to stave off the bank runs in Europe at the moment. But I'm sure you guys were seeing that over in Spain and Greece and Italy. They were starting to get mini runs on the banks because people were starting to get concerned. Um, so, and we've also seen MF Global and PFG go down. So two companies that most people thought would never go down have gone down. So my advice is don't leave any more money in your trading account than you need to trade, whatever size you want to trade. So if you're a 20 or a 30 lot trader, um, and let's say you have a run, maybe what I mean that's I don't know 450, say 500 a tick. So if you go on a losing type streak, I mean you might lose 10, 15,000, something like that. Uh, and you need the margin also. So 50 grand maybe. Is really kind of all you need to trade a 20 lot or a 30 lot, like 50 G's. Um, you can always refund the account, but don't. If you notice that you go from like if you have 50,000 in your account and you're trading 20s and 30s and you run that into 150 and you don't feel comfortable doubling up and trading 40, 50, 60, if you still want to stick with like 30 or 40 tops, take out 50 or $60,000 and put it somewhere because and I hate to I don't want to put you on edge, but I mean right now everybody is on edge, and guys are afraid to put money into uh, accounts now. It used to be you don't want to trade because you're afraid you're going to lose, or you don't want to trade because the markets have gone to shit. Now guys don't want to trade because they're concerned their brokerage is going to go under. Um, so never leave more money in your account than you actively need to trade the size you're trading. That's my first piece of advice. And if you do make it, stick it into some other assets. Find you a good piece of real estate somewhere um, where you don't obviously speculate on a housing bubble. Buy something where you're going to live, or buy a rental property that's in an area where there's always going to be renters. Things like that. Are there any tax advantages? That's also another thing. You can look into it. There can be, depending on how it's structured. You know what I mean? So actually, though, as a personal individual trader, you get the 1256 advantage. Um, Anybody who doesn't know what that is, just look it up. But it's basically it's a good capital gains tax advantage that futures traders get that stock traders don't get. But if you're running a company, you might be in the situation where you can write off cars and shit like that. So that's just something you have to determine for yourself. I would do some research. If you are going to research that or set that up, you need to get with an accountant who specifically deals with futures. Don't go to any kind of normal accountant and then ask them to look into Section 1256 contracts or corporations as futures. Call an accountant like on Lake Street in Chicago. You know what I mean? Or the Wabash or whatever. Just call somebody in Chicago and have them do your accounting for you because they know what the hell's going on. Traders where I was trading at in terms of different styles, we were all basically looking for the same thing. We were all looking for runs, weak levels, profiles breaking. The difference is, like, some guys were ultimate, tick scalpers. They like never held a trade more than 2 or 3 ticks, and so there might be a move that was 15 ticks down, and they would scalp 2, and then they'd be like, oh, still going, and then scalp 2, oh, still going, and then scalp 2, and they would take 6 ticks out of a 15 tick move, whereas another guy would just ride it. But both guys were short, you know what I mean? They both saw the momentum, they were playing the momentum, but one guy, he was okay just holding on and seeing if he can make 15 ticks. And then giving back some of it when it stopped. I was a little more cautious in that I never played numbers. Some of the guys like to play numbers. Some of them hit, some of them missed. In general, though, it's more probably just staying power. But see, most of those guys don't trade anymore. I mean, I only know of one guy who's still trading from whenever I was in that firm. I guess 2 guys. The guy that made $20 million, I know he's still trading, but he took a hit and backed off. I think there might be 1 or 2 at other firms. I don't know that they ever really made it, or are making it. I mean, one of the guys, his dad was partner in the firm, so obviously he's still trading. He can trade and lose money forever. Doesn't really matter. No, you know what? I don't. Like the guy that just would trying to make 1 or 2 trades a day and scalp out 1 tick or 2 ticks. I don't have any idea what he was looking at. Mainly because that was back in the day when I was making like 25 tick winners. I mean, not every day, but they were there to be had. So I couldn't imagine at that point in time only looking to scalp 1 tick out of it. Like these days, I can see that. Obviously it's a different scenario. I don't know if he's still in the game or not. I don't. But again, that comes back to just sort of you. It comes back to over time being able to assess your strengths and your weaknesses, and look and see what's working for you, what's not. Again, I do advise recording when you start, or if that's too much trouble, I do at least advise going over your trades at the end of the day from a standpoint of just look at your fill window real quick, and take a look and remind yourself, what did I buy, where did I sell, was that a good trade or was that a stupid trade? When you find a stupid trade, you try and eliminate them, basically. Those 23s finally held up there, but what can I say? Days like today, I would have been done at 10:05 I'm sure. Anybody else? It's probably information overload for you guys too. I'm sure everybody's like, okay, I'm good. No more questions. I gotta digest all of this, which is what you have to do. So I have the Wednesday and Thursday videos done. I'm going to upload those now to my transfer big files, and I'll get those out to you here in the next hour or so. And then we'll get today's video out probably tonight or tomorrow. Thank you, sir. Yeah, thank you guys. This was a business that I kind of started on a fluke, really. Just kind of trying to put some information out there about it, and it just sort of pyramided into these things, and I had the interest, and I think I offer a lot of good information. Hopefully, it's unfortunate the action is always out of my control. I thought we would see a lot better action here in September than we did. Really, I did. C'est la vie. And I will, yeah. Whenever I get any information on an advanced webinar or something else, I'll definitely hit you guys up and let you know. If you want to join me on Skype, and you haven't already, just hit me up or hit me, with an email, and I'll add you, and I'll pull you guys into the room, and if you want, like I dropped a couple people in the room, the Skype conversation room. Just do a quick note and say, hey, I was in the September webinar just now. Anybody else in that webinar? If you want to chat, hit me up. And that way, because there's only like 3 guys in there now, and they don't talk a whole lot. So you guys may want to kind of hook up and chat all day long. But it's only people who have been to my webinars. So you're not going to run into somebody who's not familiar with the concepts. Everybody who's in there is very familiar with the order flow. I mean, a lot of guys still use some charts and footprints and stuff like that, but everybody's really on kind of the same level in terms of at least understanding the basics of the order flow. All right, well, let's do it. Let's call it Nasty Friday. Let's go have some lunch. Thank you again, everybody, for showing up. I hope this was very helpful. I think the videos are invaluable. You obviously don't want to sit through 3 hours of me rambling on again if you're already here for it. But go back to the trades. I highlight the trades and make notes about them. Watch that action. Even some of the areas I point out where I didn't make a trade, but I point out the action, definitely review that. And I think with time, watching those videos and watching the intermediate video, you'll be able to start to see some things that you didn't see before. And especially like the last couple of days when I reviewed the videos with you during real time and just dissected them. You probably want to review those a few more times as well. Alright, so best of luck to you guys from here on out. If you have any questions, hit me up. I hope you enjoy all the holidays coming up in the next few months. And may the trading gods be with you, even though there probably aren't any trading gods. May they be with you anyway. Oh, somebody fires in a question. Got it in there. You slipped it in. Do I think the Boone volume is too low to be able to trade it outright? No. You can absolutely trade the Boone outright, but it's a different market. So the Boone Bobble Shats do trade in a somewhat similar style from a macro perspective as the U.S. Treasuries, but execution is different. So my advice is if you trade the Boone Bobble Shats, kind of start with the bobble and get a feel for how those markets move, and then you might want to transfer into the Bund if you think that you want to take the extra risk and capture the extra profit. That, but I would start with the bobble first, and go from there. I believe the Hitchhiker's Guide to the Galaxy said it was 8, the number 8, or was it 64? I don't remember. Anyway. Oh, here we go. One more. And I see you guys were holding back. You were racking your brain there, trying to think if you could fire anything else before I logged off. Is it possible to set targets based on the profile and then measuring it to how far you need to be wrong, and just let trades go with regards to management? Sure, I mean that's possible. And sometimes, like, I mean, I wouldn't have done it up here because of the action today, but somebody else asked this question a few days ago. They said, why don't we just short the top and set a 3-tick stop? And if it goes through, you get out, and if it doesn't, you're good to go. That might be a valid strategy for you. I usually prefer to stay out of very slow areas, and I like to have some confirmation. But yeah, you'll probably find that profile, sometimes your profile areas you can do that. However, see, what you've got to be careful of is what I pointed out today, which was in this area. Do you remember this? I said the market's going to get down here, probably to 22.5, 22.2, but if it does, it would seem it's so obvious of a support level that they'll probably get through there. So when knowing that kind of stuff can help you avoid taking a 3 or 4 tick loss on a trade like that, because your trade would have been buy 22.2s basically. You know what I mean? But it looked like they were going to drop it a little bit lower. I didn't know they were going to drop it as low as they did, but it did look like they were going to crack it by 1 or 2 ticks. So if you have a little bit of patience, sometimes you can get a better entry rather than just totally playing market profile. Oh no, lots of people trade the bobble. I mean people trade the bobble and the Schatz outright, and the Bund. There's spreading and hedging as well, but plenty of people trade them outright. And there's enough volume in all three of them to fire away. Just the volume in the Bund, is not nearly as heavy, and it's a lot more volatile than the other two. I mean, if you were a huge trader and you had very low commission rates, you could probably scalp ticks out of the Schatz very consistently, very, very consistently. You work an order, you get filled, you get the edge, and you just sit and wait and see if it goes. But it's only $5 a tick, so I mean you got to be moving some decent size to make any money on it. It may only move 2 ticks. Just my advice.